Welcome back, future CPAs. This is part one of our series, Forming Conclusions and Reporting, which covers the fourth area of the Auditing and Attestation section. If you're new here, don't forget to hit subscribe and share this with your fellow CPA candidates who are looking for quality review materials for free. This program is built to help you learn more efficiently in less time. We start with multiple choice questions as the foundation, then zoom out to connect them with key topics and align everything with the AICPA exam's representative tasks. The visuals are kept minimal on purpose, so you can also treat this like an audiobook, perfect for maximizing your study time on the go. Wishing you the best on your CPA journey. All right, next question. An auditor is completing an integrated audit of a public company's financial statements and internal control over financial reporting, ICFR. Which factors should the auditor appropriately consider when forming opinions? Statement 1. For the financial statement opinion, evaluate whether the financial statements are presented fairly in all material respects in accordance with the applicable reporting framework based on sufficient appropriate audit evidence. Yes, this is the core of the financial statement opinion under PCAOB AS 3101 and AUC 700 equivalents. Fair presentation in accordance with GAAP based on sufficient appropriate evidence. Statement 2. For the financial statement opinion, determine whether all immaterial misstatements were corrected by management, since uncorrected immaterial misstatements prevent the auditor from issuing an unmodified opinion. No, immaterial misstatements do not prevent an unmodified opinion. The standard is materiality. Uncorrected immaterial misstatements may be accumulated and evaluated in aggregate, but they do not block an unmodified opinion. Statement 3. For the ICFR opinion, assess whether identified control deficiencies, individually or in aggregate, represent significant deficiencies or material weaknesses. Yes, for ICFR, the auditor must determine whether deficiencies are control deficiencies, significant deficiencies, or material weaknesses. Material weaknesses lead to an adverse ICFR opinion. Statement 4. For the ICFR opinion, consider the design and operating effectiveness of controls, including whether compensating controls address identified deficiencies. Yes, the ICFR opinion considers both design and operating effectiveness. If deficiencies exist, the auditor also evaluates whether compensating controls mitigate the risk. That makes the correct answer B, 2, 3, and 4 only. Let us look at the applicable AICPA representative tasks. 1. Identify the factors that an auditor should consider when forming an opinion on an entity's financial statements. 2. Identify the factors that an auditor should consider when forming an opinion on the effectiveness of internal control in an audit of internal control over financial reporting that is integrated with an audit of financial statements. 1. Factors to consider when forming an opinion on financial statements. When issuing a financial statement opinion, the auditor considers fair presentation. Are the statements presented fairly in all material respects in accordance with GAAP or other applicable framework? Materiality. Both corrected and uncorrected misstatements are evaluated. Immaterial misstatements may remain uncorrected as long as they do not aggregate to material misstatement. Sufficient appropriate evidence. The opinion must be supported by adequate audit evidence across all assertions and accounts. Consistency and disclosures. Evaluate whether accounting principles are consistently applied and disclosures are complete and transparent. Going concern. Consider whether substantial doubt exists about the entity's ability to continue as a going concern. 2. Factors to consider when forming an opinion on internal control over financial reporting, ICFR. In an integrated audit, the ICFR opinion is formed separately but linked to the financial statement audit. Key considerations. Design effectiveness. Were controls designed to prevent or detect material misstatements? For example, is there segregation of duties or proper authorization of transactions? Operating effectiveness. Did controls operate consistently during the year? Were they performed by competent personnel at the right frequency? Deficiency classification. Control deficiencies are evaluated as control deficiency, least severe, significant deficiency, important but not material, material weakness, a reasonable possibility of material misstatement not being prevented or detected. Compensating controls. If a deficiency is identified, consider whether another control offsets the weakness. Evidence. Use walkthroughs, tests of controls, inquiries, and observation to assess design and operating effectiveness. If material weaknesses exist, the auditor issues an adverse ICFR opinion. If only significant deficiencies exist, the opinion may still be unmodified, but the deficiencies must be communicated to those charged with governance. Think of the integrated audit like reviewing both a restaurant's food and its kitchen. The financial statement opinion is about the food on the table. Does it look good, taste right, and match the recipe, gap? Small imperfections, immaterial misstatements, don't ruin the meal. The ICFR opinion is about the kitchen. Are the chefs following proper procedures, washing their hands, and storing ingredients safely? If the kitchen has serious hygiene problems, material weaknesses, even if today's meal looks fine, you have to give a negative review on the kitchen. On exam day, remember, financial statement opinion equals fair presentation based on sufficient evidence. ICFR opinion equals design and operating effectiveness, classification of deficiencies, and compensating controls. All right, next question. An auditor is completing an audit of a non-issuer's financial statements and evaluating the appropriate form of report. Which conclusions are appropriate under professional standards? Statement 1. If the financial statements are materially misstated, but the effect is not pervasive, the auditor should issue a qualified opinion. Correct. When financial statements are materially misstated, but not pervasive, AUC 705 requires a qualified opinion, except for Statement 2. If the auditor cannot obtain sufficient appropriate evidence and the possible effects of undetected misstatements could be both material and pervasive, a disclaimer of opinion is appropriate. Correct. When evidence is lacking and the possible effect is both material and pervasive, the auditor issues a disclaimer of opinion because they can't form an opinion. Statement 3. If substantial doubt exists about an entity's ability to continue as a going concern, the auditor should add an emphasis of matter paragraph to highlight the disclosure but still issue an unmodified opinion, if disclosures are adequate. Correct. Going concern with adequate disclosure results in an unmodified opinion plus an emphasis of matter paragraph. If disclosure is inadequate, that would drive a qualified or adverse opinion. Statement 4. If a significant subsequent event is properly disclosed, the auditor should issue an adverse opinion and include an other matter paragraph to emphasize the disclosure. Incorrect. Properly disclosed subsequent events do not require an adverse opinion. An emphasis of matter or other matter paragraph may be added to highlight the issue, but adverse opinion is only appropriate when the financial statements as a whole are misleading or misstated. Thus, the correct answer is C, 1, 2, and 3 only. Let us look at the AICPA exam tasks on audit opinions and emphasis of matter, other matter paragraphs. All right, let's talk about audit opinions and those extra paragraphs auditors sometimes add. I'll walk you through the types of opinions first, then we'll cover emphasis of matter and other matter. Think of this as the menu of audit reporting. 1. Types of audit opinions. Unmodified for non-issuers. Unqualified for issuers. This is the clean opinion, the gold star. It means the financial statements are presented fairly in all material respects, in line with GAAP. Nothing major is wrong. Now, sometimes, even with the clean opinion, we may add a paragraph to highlight something important, but the opinion itself stays unmodified. qualified opinion. This is the except for opinion. We're basically saying the financials are good except for this one material issue. That issue could be a misstatement or a scope limitation. Key point, it's material but not pervasive. Adverse opinion. Here, the wheels fall off. We're saying the financial statements are materially and pervasively misstated. They're misleading as a whole. That's the worst case scenario for a company because it screams, don't trust these financials. Disclaimer of opinion. This is when we throw up our hands and say, we can't give an opinion. Why? Because we couldn't get enough evidence, and the possible effects are both material and pervasive. Another reason is if our independence is impaired. If we're not independent, we simply cannot issue an opinion. 2. Emphasis of matter and other matter paragraphs. Now let's talk about those extra paragraphs we sometimes tack on. Emphasis of matter. This draws attention to something already disclosed in the financial statements. It doesn't change the opinion. It just says, hey, reader, don't miss this. Examples of a going concern uncertainty, a big subsequent event, or some unusually important transaction. Other matter. This one highlights something not in the financial statements, but still important for users to understand the audit. For example, we might restrict the use of our report, explain comparative reporting responsibilities, or mention the involvement of another auditor. Here's the simple way to remember the difference. Emphasis of matter is inside the financial statements. Other matter is outside the financial statements. So think of audit opinions like restaurant reviews. The food is great, nothing wrong here. That's unmodified opinion. The food was great, except the soup was too salty. That's qualified opinion. The food was awful. The whole meal was a disaster. That's adverse opinion. I couldn't taste anything. The lights were out and I couldn't even see the plate. That's a disclaimer. Now, emphasis of matter is like adding, by the way, the restaurant is moving locations next month. Other matter is like saying, oh, and this review is only for private use by the Food Critics Club. So, on the exam, always match the opinion type to whether the problem is material, pervasive, or just limited. And remember, emphasis of matter points to something already disclosed, while other matter points outside the financials. All right, next question. An auditor is completing an integrated audit of a public company's financial statements and internal control over financial reporting. Which conclusions are appropriate regarding the form and content of the auditor's reports? Statement 1. If the financial statements are fairly presented in accordance with GAAP, but there is significant uncertainty related to litigation that is properly disclosed, the auditor issues an unqualified opinion and adds an explanatory paragraph for an issuer or an emphasis of matter paragraph for a non-issuer. Correct. If litigation uncertainty is adequately disclosed, the auditor issues an unqualified opinion but adds an explanatory paragraph, PCAOB issuers, or an emphasis of matter paragraph, non-issuers. Statement 2. If a material weakness in ICFR is identified, the auditor must express an adverse opinion on ICFR, even if the financial statements are fairly presented. Correct. A material weakness in ICFR always requires an adverse opinion on ICFR, regardless of whether the financial statements are fairly presented. Statement 3. In an integrated audit, the auditor may issue separate reports on the financial statements and ICFR, or a combined report covering both engagements. Correct. In an integrated audit, the auditor can issue a combined report covering both the financial statement audit and ICFR audit together, or separate reports. Both are acceptable under PCAOB standards. Statement 4. If the auditor concludes that ICFR is effective, but management's report on ICFR contains a material misstatement, the auditor may still issue an unqualified ICFR opinion without modification, because the effectiveness of controls is what matters. Incorrect. If management's report on ICFR contains a material misstatement, for example, it claims there are no material weaknesses when in fact there are, the auditor cannot issue an unqualified opinion. The auditor must modify the report to explain the inconsistency. That makes the correct answer C, 1, 2, and 3 only. Let's talk about the form and content of the auditor's report in an integrated audit. There are really two things happening here, the financial statement report and the internal control report. Both have rules on when to add paragraphs or modify the opinion. 1. Auditor's report on financial statements. The base opinion is unqualified, unmodified when the financial statements are presented fairly in accordance with GAAP. If there's something important already disclosed in the financial statements, we highlight it with an explanatory paragraph for issuers, PCAOB, or an emphasis of matter paragraph for non-issuers, AICPA. Classic example, going concern uncertainty, significant litigation, or major subsequent events. If disclosures are inadequate, we move from adding a paragraph to modifying the opinion, qualified or adverse. 2. Auditor's report on ICFR. The auditor evaluates the design and operating effectiveness of controls. If controls are effective, unqualified opinion. If there's a material weakness, the auditor must issue an adverse opinion, even if the financial statements themselves look fine. Why? Because the weakness creates a reasonable possibility that material misstatements could occur. If the auditor can't get sufficient evidence on ICFR, they disclaim the opinion. 3. Combined versus separate reports. In an integrated audit, the auditor may issue one combined report covering both the financial statements and ICFR, or two separate reports. Both are acceptable. It's a matter of presentation, not substance. 4. Management's ICFR report. Management must provide its own report on ICFR. If management's report contains a material misstatement, the auditor cannot ignore it. The auditor has to modify their opinion or add an explanatory paragraph to point out the inconsistency. Think of this like reviewing both a student's essay and their study habits. The essay review, financial statements, might be fine. Grammar is good, arguments make sense. The study habits review, ICFR, could still be terrible. The student crammed at the last minute, used unreliable sources, and skipped proofreading. If study habits are weak, you have to say so, even if the essay turned out fine. And if the student claims, my study habits were perfect, but you saw them pulling an all-nighter with no notes, you can't just let that slide. You have to call out the inconsistency. On exam day, keep it simple. FS report equals unqualified or unmodified if fairly presented. Add paragraphs when disclosures are important. ICFR report equals adverse if material weakness, unqualified if effective, disclaimer if scope is limited. Reports equals can be combined or separate. Management misstatement, you must modify your report. The question? A practitioner is engaged to report on a company's non-GAAP KPI framework measured against a published industry standard. Some users are public, others are specified lenders. Management prefers an assertion-based examination. The board asks if a review would suffice for a smaller sustainability dashboard. Which statement is not appropriate under SSAE? Option A, assertion-based examination. This is accurate. In an assertion-based exam, management must provide a written assertion. If they refuse, that's a scope limitation. The practitioner should normally withdraw. If law forces them to proceed, the report must be modified and restricted to specified users. That is consistent with ATC 105 and ATC 205. Option B, this is correct. In a direct exam, the practitioner evaluates the subject matter directly against the criteria. No separate assertion is needed, but management still acknowledges responsibility and provides written representations. Matches ATC 205. Option C, review engagement. Also correct. A review provides limited assurance, based mainly on inquiries and analytics. The conclusion is negative assurance. We are not aware of any material modifications. The report states subject matter, criteria, and that the scope is less than an examination, consistent with ATC 1010. Option D, examination report must list all procedures in detail. This is not appropriate. Under SSAE, the practitioner does not include detailed procedures in the report. The report provides an opinion, reasonable assurance for exams, but doesn't list each step. Including all procedures would be misleading and not required. So the answer is D. All right, let's unpack the representative tasks here in plain language. Identify the factors that a practitioner should consider when issuing an assertion-based examination, direct examination, or review report, and determine the appropriate form and content of an accountant's report for an assertion-based examination, direct examination, or review for an attestation engagement. 1. Factors when issuing an assertion-based exam, direct exam, or review. Assertion-based examination. Here, management gives you a written assertion saying, yes, this KPI framework complies with the criteria. Your job is to test that claim. If they won't give the assertion, you have a scope limitation. Normally, you walk away, unless a law forces you to continue, in which case you issue a modified report, usually restricted to specified users. Direct examination, different flavor. Instead of just checking management's assertion, you, as the practitioner, directly evaluate the subject matter against the criteria. No assertion required, but management still must admit responsibility and give you reps in writing. This is the lighter touch. Instead of reasonable assurance, you're giving limited assurance, mostly inquiries and analytics. The conclusion is negative assurance. Basically, we didn't see anything that makes us think it's materially wrong. Form and content of the report. Examination report provides reasonable assurance. You give an opinion like, in our opinion, the KPI framework is in accordance with the criteria. You don't list all your tests. Reports must identify the subject matter, criteria, responsibilities of management and the practitioner, and the level of assurance. Review report provides limited assurance. We are not aware of any material modifications. The report also states that procedures are substantially less in scope than an examination. Direct versus assertion-based exam reports. The format is similar, but in a direct exam, the opinion is directly on the subject matter. In an assertion-based exam, the opinion is on management's assertion. Think of it like checking homework. Assertion-based exam, the student says, I got all the math problems right, and you grade their answers to confirm. Direct exam, the student doesn't say anything. You just work the problems yourself and see if they match the criteria. Instead of grading every answer, you glance at the work, ask a few questions, and say, I don't see anything obviously wrong, but I didn't check everything. And the report? You don't hand over a step-by-step of how you graded each question. You just give the grade. All right, next question. An auditor is engaged to perform an agreed-upon procedures, AUP, attestation engagement on a company's royalty payments to a licensor. Which considerations and reporting elements are appropriate under SSAE ATC 215? Statement 1. Before accepting the engagement, the practitioner should confirm independence, agree on the procedures to be performed with the engaging party, and evaluate whether the criteria for measuring the subject matter are suitable. Correct. Independence is required in AUP engagements. The practitioner must also agree on the procedures with the engaging party up front and make sure the criteria being used to measure the subject matter, like royalty contract terms, are suitable. The AUP report should identify the procedures performed and the findings obtained without expressing an opinion or conclusion. Correct. The AUP report lists the procedures performed and the findings. It does not give an opinion, reasonable assurance, or conclusion, limited assurance. It's just factual reporting. Statement 3, the report should state that the practitioner's responsibility was to perform the procedures and report the findings, and should also include a statement that the engagement does not provide assurance. Correct. The report explicitly states, we were engaged to perform the agreed-upon procedures. Our responsibility is to perform the procedures and report findings. We do not express an opinion or conclusion. That's baked into ATC 215. Statement 4. Because AUP reports provide factual findings only, they may be freely distributed to all users, since no level of assurance is expressed. Incorrect. Distribution is restricted. Because procedures are tailored to specific users' needs, the report must state that it is intended only for those specified parties. It cannot be freely distributed to the general public. So the correct answer is C, 1, 2, and 3 only. Here is the AICPA exam tasks. Identify the factors that a practitioner should consider when issuing an agreed-upon procedures report for an attestation engagement. Let's break down agreed-upon procedures engagements tasked the way the standards do, but in plain language. 1. Factors a practitioner should consider before and during an AUP engagement. Independence. The practitioner must be independent. Same rule as for an examination or review. Agreement on procedures. The procedures must be agreed to with the engaging party, for example, the licensor, lender, or regulator. The practitioner doesn't design them alone. Suitability of criteria. The criteria must make sense for measuring the subject matter. In this case, it's probably the royalty agreement terms, how royalties are calculated and paid. Restriction of use. Since the procedures are custom-built for specific parties, the report is not for general use. Only those specified parties should rely on it. 2. Form and content of the AUP report. Identification. The report names the subject matter, criteria, and specified parties. Procedures and findings. It lists each procedure performed and the factual findings. Example, we recomputed royalties for 25 transactions and found no differences. No assurance. It explicitly states that the practitioner is not providing assurance. No opinion, no conclusion, just reporting results. The report includes a paragraph saying it's only for the specified parties who agree to the procedures. Think of an AUP like a mechanic's inspection when you buy a used car. The buyer says, please check the brakes, oil level, and tires. The mechanic does exactly that, then reports back. Brakes are worn, oil is clean, tires are fine. The mechanic doesn't say, I conclude this car is roadworthy. That would be an opinion, and the report isn't useful to the whole world. It's tailored to the buyer who asked for it. On exam day, remember this. AUP equals specific procedures, factual findings, no assurance, restricted use.